Hey, good morning, everybody. Welcome to Trading Index Options. I'm Connie Hill sitting in for Ben Watson. Ben is in New York City. He's there for one of our events that's going to be taking place there tomorrow. And so he's not with us today in this capacity, although I'm sure you could find him in other places as he's in New York. Well, I am happy to see you here. Do you have personally already developed a systematic approach to generate cash every week after week after week after week? Now, some of you might be able to say, yeah, it's working good for me. And there might be others of you that say, I would really like to do that. Well, today that's what we're going to focus on, is developing a very specific process that you can repeat the same time week after week after week. Okay, I am joined in the chat by Cameron May. I'm glad Cameron's here. He's a great veteran of the markets. So as you have questions, he's here to help us answer those questions. There might be some things I can't quite get to that Cameron might be able to help us out with. He's already been doing that so far this morning. I see some of the chats in there. So as you have questions, let us know. I'll keep my eye on the chat, and Cameron will as well. If you're listening to this on a recording, because I know there are lots of you that do, when you have a question, go ahead and put it in the comments section of YouTube, and I go back and check those throughout the week so you can get your questions answered quickly as well. Now, I do hope you're following us on X. I'm Connie Hill CS. Cameron is Cameron May CS, and we'll post educational content out in our X account. Things that we notice, maybe with some charts, things that we think you might find interesting or observations we're going to share with you. And so it's free and easy to follow us. So enjoy doing that. If you haven't already subscribed to our Trader Talks channel, I'm going to encourage you to do that as well. That makes it so much easier for you to see our content. I'll show you a little bit about that later on. Let's go through the disclosures and get down to business. What we talk about today is for education and informational purposes only. Don't consider it a recommendation. Investing involves risk, including the loss of principal. Past performance is no guarantee of future results. We'll be using lots of different ticker symbols here, but keep in mind they are not intended to be recommendations. We will be working with European styled options here today, which means that one of the beauties of that is that they do not do assignments early. When we're talking about probabilities, which we're going to talk a lot about probabilities today, keep in mind they are theoretical in nature and are not guaranteed. We're going to be using the Paper Money software application. It's what you download to your computer. It's the most robust version of Thinkorswim. And we're going to use a couple of tools that Thinkorswim has on it for our discussion here today. Now, I do want to say a quick hello to some of you folks that are here live. We've got Ning Yen, Carol, Ho, Andrew, Life in the Fast Lane, Kevin, David, Riceboard, Bush, Harlot, 3000, Vic. I think I've caught most of you there, of the friendlies. Thank you for being here week after week. We love seeing you in our classes. All right. Typically, what we do in this class, we're going to take a look at the markets, get an idea of what's going on. We're only going to use index options in this class, and we're going to be looking at some examples. All right, so let's hop on over to Thinkorswim. Let's get started here. And actually, I just want to use one chart here to begin with. Let me just maximize this chart. There we go. All right, SPX. What's been going on in the markets? Do you feel like they're slowing down, or do you feel like, just a little pullback? Now they're right back up. Okay, right now it looks like what? The SPX is up about 27 points. This is a one-year view. I'm going to just kind of zoom in here a little bit more closely. You know, last week we had a little bit of a sell-off. We had a brand new high, which we kept creating new highs, new highs, new highs. I shouldn't say we didn't create them. The SPX created new highs, right? All-time highs. And then it had a little bit of a pullback, but it might have felt really sharp to us. Was it really sharp? Well, it could be to some people, but notice it went below the 10-period moving average, and it didn't get down to our 50, which is our red line here. Okay, so did it even pull back to an intermediate time frame? No, it really didn't. On the kind of a couple of studies we're going to consult with now and again today, we've got a MACD. gives us an idea of the momentum. RSI gives us that idea as well. And so we're going to kind of use those in conjunction with each other. The MACD right now in the SPX is showing basically that it's starting to roll back up, right? It's been on the bottom side of the zero. So we've had these red bars. The bright red bars means they are continuing to drop. The darker burgundy color bar, when it goes there, then it's an indication it's not continuing down to the downside, but it's starting to make its way up. And then the RSI, we have overbought and sold areas on it. 70 and 30 are the boundaries we're looking on that. Something over 70 means that bulls are in control. The market's quite bullish. And if it's below 30, we know the bears are in control. And then we're really kind of looking at direction. What direction is it going? With this little pullback, let's see how much the RSI dropped to. It looks like it dropped to a reading about 47. So it did go under 50 there. And so sometimes traders will look at it, well, 50 is kind of a boundary of saying, oh, okay, now it really is selling off. But right now we're at 57, so we're above that 50 area. Carol says, hey, we should look at the VIX. The VIX is almost 17. And, we have been tracking the VIX. Let's look at the NDX first, and then we will look at the VIX. All right, NDX on the NASDAQ. Same thing here. Very similar patterns right now with the NDX and the SPX. They're trading in sync with each other quite well. It's interesting because the Dow and the Russell seem to be kind of on the same page as well. If one of those has an up day, the other one seems to, regardless of what's going on in the SPX and the NDX, which is just kind of a little interesting. Here on this little dip, the MACD, definitely went down. Let's see where that RSI went to. It went to about 48. I think we said the SPX was at 47. So they're both kind of getting down into that little bit of a range. Again, didn't go all the way to the 50. Looks like it's coming back up. Today will be an interesting day because as we saw the index here rise, it got a little bit higher here, but closed down on the day yesterday. And one of the things that we're looking for is to see, does it make a lower high? With this here, I would maybe just call it some sideways action, and then we will see if all of a sudden it dropped lower and we ended up having a bearish candle on the day, then this candle here from yesterday would become the first lower high, which can be the beginning of a trend change. Got my tongue tied there for a second. And so we're really trying to look for those types of things, right? Because here on the pullback, did it have a lower low? It's interesting. It comes back pretty equal to these shadows back here on these candles here. So I would say it's an equal low with this candle. And then we'll see what today brings. If today brings some bullish activity, then we'll see if it does go back and form a higher high. We'll have to see here. Now, I'm really interested in some of your comments here. Let's see, Bruce, what is Bruce's problem? You don't know how I keep getting it wrong. I don't know what you're doing wrong. I'm not sure, Bruce, what your question was. Maybe, hopefully, Cameron's helping you out there with what it was that you're saying that you're doing wrong, because I can't quite see that in the chat here. Okay. Jack wants me to share the chart. I will in a minute, Jack. Not yet, but in a minute I will, and I'm going to actually share the grid with you, okay? Because I've got a couple of charts we're going to refer to here today. VIX, I think Carol mentioned it was about 17 right now. Man, smack on 17 it is. So when we had that pullback last week, right, we had the VIX kind of moving up into, especially on this day, where the market's starting to be more volatile. Okay, down here, where it was around 15, 16, 14, volatility was pretty low, and there was not a lot of volatility that we could see in the markets. The markets were just kind of churning along, right? It's just in that big pullback when we got the steep, rise here on the VIX, and today it seems to be dropping. If it's dropping today, then we're going to think that probably that should be reflected in, say, the SPX, that we might be able to see a little bit of bullishness. Now, right now, there is a little bit of bullishness, so we'll see what happens here as our time develops. All right. in your mind, and answer this to yourself, okay? Are you more bullish, bearish, or neutral right now? Are you more bullish, bearish, or neutral? Tell the dog, tell your cat. I've got a brand new cat. He might want to hear about this. Just so you're kind of making that connection. You're making those decisions yourself, okay? Let's take a look at, well, we're going to go back to the SPX here. I told you I had a couple of different charts. So we're going to go back to those charts. This chart on the right, I'm going to zoom back out, get a little bit longer picture. I've got a 1-year chart on it, although we're looking maybe at just like starting in January. When you guys are telling me what you're thinking, okay, we're seeing bearish, bearish, neutral, 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 upward drift. I like that word, Kelly, drift, neutral, neutral, and bearish, neutral, neutral, neutral. Yeah, we're kind of getting that feel that maybe things are just kind of slowing down a little bit, maybe we need more time to see if it's going to continue to go sideways or if it's going to resume the uptrend that we've seen. But we know this didn't amount to a whole lot, at least yet, right? So yeah, I think it does put us in a little bit more of a neutral stance that we are looking at the market saying, yeah, it really could go either way. So on the right side, we've got, like I said, the 10, the 50, the MACD, and we got the RSI. We've talked about that a little bit. RSI right now on the SPX is pointing up, and I did mention here that the MACD line, that bar there on the histogram, is dark burgundy, which means ever so slightly starting to roll up, okay? On this side of the chart, I have a 3-month chart, which kind of we had here when we were zooming in, have the same moving averages. We have implied volatility here on specifically the SPX. So we can see, yeah, we see the big spike. We see it's coming back down here, about 17 right now. And then I have a probability cone. And I don't know if you guys have worked much with probability cones. I'm just going to go to my studies and show you the probability cone. You just come over here and type in PROB, and by the time you get the B in there, this is the only one that's left. And really, it is letting us know we've got it set here on the probability range. It says 68. Does everybody know what that means? I think there's so many of you in here that probably really know what that means. It's a way of saying or displaying a 1 standard deviation of a bell-shaped curve. I'm going to take us back to bell-shaped curve days for a moment, okay? I am not the best artist in the world. What this is saying here, our probability curve, is that it's going out 1 standard deviation from the mean, which represents about 68% of the data point, right? Ricebird says 2 standard deviations. It's actually just 1. Speak, Ari, yeah, it's 1 standard deviation. All right. Let's go ahead and select OK here. And we're going to test my artistic skills a little bit. And I'm going to bring up here just a blank document, blank screen here, because I am going to work on my drawing skills here with you. Now, you may have had statistics, you might not have had statistics. And I am not the best artist, but I'm going to try to do this justice. This should look like both sides look the same. This one maybe needs to come out here a little bit, right? And this is what we call a bell-shaped curve. And essentially, it's letting us know where the data points are, where the prices are, where they're likely to go. And so if we have a line smack down the middle, so pretend that's exactly even. If I had like a little grid behind it, maybe that would help me get a little closer. But just imagine that's exactly smack in the middle. We call that the mean. And then this side away from the mean and this side away from the mean. Over here represents about 34% of data points. Over here represents about 34% of data points. So the two together make up that 68%. Okay. So when we're looking at data and we're seeing where it can go, we will say, well, the majority of the points are going to be in one standard deviation away from the mean, thus that 68%. Now, if we go out further, now my lines aren't going to be perfect here, okay? But if these lines go out a little bit further, let's go maybe say down here and down here, that represents the second standard deviation, right? Because it's going even further than beyond here. It's going a little bit further out. We're going to call these the tails, and this is not a perfect drawing, okay? But this information here, this is encompassing 96% of the data, okay? 95.8, but I'm going to round to 96, okay? Of the data points, which you're thinking there, well, that probably is going to be a majority then, right? So what this probability cone is on the graph behind me is basically this bell-shaped curve tipped over, okay? It's just like your little ice cream cone tipped over. And so we're looking at it a quarter of a turn to the left. That's really what it makes what it is. Oh, Carol thinks this looks like Darth Vader. If it were Halloween, I'd probably say, yeah, looking a little ghosty. Yeah, a little ghost there. But it's a helpful tool. Kelly says, yeah, that's a good tool for iron condor strike selection. We may be doing something a little like that here today. Okay, that is your lesson about bell-shaped curves for anybody that needed a reminder why we would even be talking about it. And let's get rid of the extra drawings there. All right. Let's go to, today we're going to put together a trade here that is going to be based on probabilities and based on where we don't think SPX is going to go. And at the very beginning, I asked you if you had a way to, if you've developed a way to maybe create a process that you can follow week after week after week. Maybe you have. That would be so awesome. I'm happy for you. We're going to talk about doing that for this class. Now I'm going to come out here. I'm going to remove my information. Don't want you to cheat. One of the really nice things about the SPX is that we have, look at this, almost a day expiring almost every day. And by the time we get it out here a little bit further, yeah, it's going to be actually every single day, except for weekends. Okay, we'll skip the weekend. We'll give Saturday and Sunday a break, per se, as far as expiration dates. Now, what we're going to do is we're going to go about 14 days out. One of the things with SPX options that some traders find pretty helpful is just the idea that there's a lot of activity. If we were to look at 14 days out on the NDX or the RUT, not that this is like a ton, but there'd probably be even a little bit more sparse than this. But as we get closer to the options expiration day, what happens? So many more contracts start coming on, right? If we come out here for a moment and just like say open 2 days to options expiration, and I'm going to scroll down here to where we're closer to the at the money. Go down a little bit more here. Trying to see, there we go. I skipped past the shading here. But you can see we've got thousands and hundreds of contracts. And if you go back and you look at this, say you were to look at it every week, and you pulled up the 1 day to expiration or 0 day to expiration, 1 day to expiration, 2 day to expiration, 3 day, 4 day, 5 day, you're going to notice a pattern that as we get closer, these numbers get really big. When we get 0 days to options expiration, I know Ben's taught a little bit about these 0 days, and I have as well. We see like thousands, okay? So look at this. Look how many thousands of put contracts there are out here. I mean, it's like you realize you're not the only fish in the sea. You're like, yeah, lots of other fish in the sea. So as we get closer to that options expiration day, we're going to expect that open interest to pick up. But for where it is at the moment we are right now, let's just say it's sufficient enough. Okay, so we're going to go out 14 days. We're going to sell a vertical where we think it can't go, or is not as likely to go based on that probability cone. And we may sell a couple. We'll see here. We'll see what our time allows us to do. And then with the idea in mind that when you get back in class next week, that you would be basically taking the trade off, that you would let that time decay for 7 days. Okay. And so we've got to determine, are we a little bit more bullish? We a little bit more bearish? The majority in here, we're saying, yeah, we are neutral. Okay. NDX is up almost 200. That might put a little flavor in the NDX. And the SPX and the NDX have been trading very similar to each other over the last few days. So interesting. So let's come out here. We're going to go back out to the probability column. We're just going to kind of use this. Overall, we see what the trend has been doing. And yeah, it looks like maybe we're even getting a little bit more. We can see it better here of a green candle. I'm going to say it's maybe not quite up to yesterday's open, but it's getting close, isn't it? It'll be interesting to see if it surpasses that and goes a little bit higher. Well, if we're going to go out 14 days in time, let's see where the index shouldn't get to, okay, based on probabilities. It doesn't mean it really couldn't actually go there, because we know it can. But that's going to put us out to the 20th of August as far as an expiration date. So let's come back to our charts here. Let's come over here to our column. And maybe I'll just maximize this cell for a moment so that we're just kind of seeing the details of it. And I'm going to kind of squish down our implied volatility. Interesting that it's dropping a little bit. Volatility tends to drop when things are a little bit more bullish, so a little bit of correspondence there. Now, I've got on my chart going out 20 days. I like to see about a month's worth of extra time frames out here. So we're going to come along here on the probability curve, and we're going to just kind of see where this is August 14th. And we're going to find August 20. Where's August 20? August 20 is right there. Now I'm touching it just as closely as I can, okay? And what I'm going to do, I'm just going to put a little mark here. I want to stay on my day, get back over to the 20th, get my mouse right exactly in the right spot. And what I want to do is just kind of put a line out here. So it looks like it's about 65.54. So that we can have some round numbers, let's go make this 65.55. Okay, that's going to be close enough for our purposes here. I'm going to update it here in the cell, 65.55. And then let's do it on the downside. Let's see, okay, if we go 14 days out, you know, the expectation is that the price will be flipping around in here. And as we go out a little further in time, what happens? That cone broadens out and more data points start coming in. So the 20th is about right there. We're going to go straight down to this line. I'm going to do the same thing. Try to get right smack on the line on the 20th. That looks to be about 61.35. Let me draw that in here. As close as my hand can do. 61, not 61.40. I think that's where that was. Does that sound about right? Okay. I'm going to write those values down. They've shifted a little bit since I was looking at them earlier here. So 65.55, 61.40. So if we're going to put a trade together, we're going to sell something that we think is going to be on the other side of where that price might be. Let me answer a couple of questions here. Yeah, as John noticed, as we were looking at the puts and the calls and the open interest, there's a lot more puts out there. The thing is, we don't know if it's buying or selling, do we? We really don't. Sometimes people assume it's buying, but obviously, you know, there's a combination there. There is some uncertainty as to several different things, right? The Fed spoke earlier, so we know what's going on there. But tariffs we're getting tariff information all the time, aren't we? So one of you chatted out there. Black Shark 7 says, why are indicators different from the small account class Monday? That might be a good question. In our webcasts, we're not always using the same studies. We're not always, and from instructor to instructor, you'll notice that as well, that we use a lot of different tools. And in this particular strategy of looking at index options, many traders, because it's such a short time frame, man, they're really interested in selling the option. So we're exploring a selling strategy here today. And the key here is looking at the probabilities. What's the probability that SPX is going to be in a particular range by a particular date? And so the approach for our index options today could be totally different from our trading a smaller account. It's going to be totally different than the class that's going to be coming up after mine, which is managing an options portfolio. There could be different indicators used, just kind of depending on what the instructor is focusing on. We have a class Cameron teaches about advanced charting techniques. He talks about a lot of different studies that you could employ and why you might, where that might be appropriate. So we're not going to have a vanilla template across the board where we're all looking at the same thing. There are some things in common. Maybe we'll have an RSI on the chart like I did on the other one. There could be some commonality there. But yeah, it's going to be different class to class. Okay. Sia says we should place it at 6,100. Well, we've got it at 6,140. You're thinking maybe come down a little bit further out. Yeah, that would be where we're thinking it's not going to be at that day, right? Would be around that 6,100. That's true. Let's go out to the trade tab. Let's see what we can go. Now, that says, well, if you want to be really precise here, use the probability analysis tab, which we actually are going to do in a minute. Okay, we're going to use the analyze tab here in a moment. Let me get our drink here. All right, as we come over here to the trade tab, what we already discussed is, okay, we're going to sell either a put spread or a call spread, whatever direction, quite honestly, since we're neutral, we could consider doing both. Okay, we'll see how much time we have. We're going to start out with one of them. And what I have decided to do is just to start on the put side. Okay, just because we are above the 50, it's working its way back up today. We'll see. All right. Tomorrow we might look at it and go, oh, maybe we feel more inclined to doing a call spread first. But today we're going to look at a put spread. So on our values, I had 6140. C was saying use 6100. I'm just going to write that number down. And I had to bring up 100 strike so we could get way far out of the money. Okay. So if we look at 6140, that's about a 16 delta. I think one of you typed that in here as well, that corresponds to around a 16 delta. And I've got two things on my option chain here that give us an idea of likelihood of expiring out of the money or in the money on options expiration. So delta, for years and years, we used delta as a rough gauge of the probability of an option expiring in the money. And we used it just fine for years and years. And then developers of the Thinkorswim platform became more sophisticated and fine-tuned those calculations. Okay, but for a long time, yeah, we're just looking at delta. If we look at, say, 6140, we've got about 83 contracts here. Now, this column here is the more, I'm going to say fancy calculation, a more precise, not fancy, we're going to say precise calculation, that the option or the probability of 6140 expiring out of the money come options expiration day in 14 days is starting here about 83%. So those are pretty decent odds, okay? An 83% chance that if we were to sell that strike price, that it would expire out of the money. So we're going to feel a little bit more comfortable there than if we were selling, say, a 30 delta. If we're selling a 30 delta, we would not be having probabilities that high. And we were using the probability cone to capture where that one standard deviation would be so we could go out sufficiently. Now, see, you might, you said, 6,100 might be okay. And that would be a little bit further out of the money, a little bit more room, a little bit lower delta, and a little bit higher probability of expiring out of the money. It is nice there because we've got 999 contracts. So there's a lot of interest in that area. Okay. I'm going to stick with our 6140 to begin with. We're going to target about $1 credit. If we get more than $1 credit on our 6140, then we are going to go further out of the money. Okay, but this is going to be our starting point here. 83 contracts, so not too bad. We might be interested in spreading it out a little bit because these strike prices don't have a ton, but we're just going to be doing one contract in our class here today. So let's go to our 6140 where we were starting. Let's do sell the vertical. And it's going to give us about 50 cents, 45 cents. That would mean if we went out even further out of the money, like say to 6,100, we might not get much at all. Okay, but let's spread this out a little bit. Instead of by $5, many times I like to go $10 wide. In this one, let's go $15 wide, okay, just for that open interest. So we'll change this to 6125 here. Go a little bit further. In a $2 or in a $10 wide spread, typically I might be looking for $10. In a $5 wide spread, maybe 50 cents. And so because we've spread it out even a little bit more now, which also increases our risk, then we're looking at a bigger credit to bring in here. Okay. Now you might not feel comfortable with these strike prices. You might feel entirely comfortable selecting other ones. I'm not opposed to that. We've got a blast all in here. Oh, Cameron's helping out here with about how to choose an expiration and price. And, yesterday I taught a class about that as well in our selecting an option strategy. And we talked about the definition of these strike prices and maybe what they might mean depending on what you might choose. Okay. So choosing something further out of the money, all right, like say the 6,100, let's just because Sia suggested this, let's just throw this on as a comparison. It's a little bit further out of the money. That gives us an 87% probability of success. Now, 6,100 is beyond our boundary of where the chart is, isn't it? Because we put our mouse here at August 20th. And then that was about 6,140, 6,100 gives us a little bit more leeway. Okay, that would maybe give us a little bit more leeway there on the 20th of August. That might be a possibility here. Okay, somebody had a question about, how to pick the timeline on expiration. In the index class here, we're going to be a little bit more aggressive than maybe what somebody might start using. Okay, I teach short verticals on Thursdays, and in short verticals, we'll talk about a common time frame being anywhere from say 20 to 40 days as being kind of the ideal window. Sometimes we have to go out a little bit further. Sometimes we might have to go out to 50 days. But we're looking for that short and intermediate time frame where the theta decays more rapidly. And that's what we're looking for. This is just a theta decay play. We're looking for time value to erode. Okay. So in this class, I am being more aggressive than what I would do maybe in my short verticals class. Okay. Doesn't mean you have to be aggressive that way. It doesn't mean you have to trade that way by any means. Okay. But for our purpose, we were looking for an opportunity that maybe we could sell something today, 14 days out. By the time we get back to class next Wednesday, or 7 days will have passed, and we'll see how much of that we've been able to collect and to capture simply by letting time expire, let time go by. Let's let's go ahead and do this. I did want to do that little comparison here. I'm going to get rid of this one right now because I want to use the strike price where the probability cone was at that 61.40. But again, it could make sense to some of you to go a little further out. I mean, even, actually, let's experiment with this. I can be flexible here. Let's go out to 61.25, which is even further than 61.40. It's got a 14 delta, so the delta doesn't change all that much. Probability is a little bit higher. Instead of 82%, is 85% probability of expiring out of the money come options expiration day. And I'm just going to delete both of these here. And let's sell this one. Get my mouse to cooperate here. Okay. What did I tell you? I said with a $5 widespread, maybe we could target 50 cents. A $10 widespread, maybe target $1 of credit to bring in. So I'm okay with this ballpark that we're in, 45, 50 cents. I'm going to go ahead and change that back to the 50 cents that it was. And we're going to put the lock on it there. Okay. Now, we're not guaranteed that this is going to go our direction. We would love for the price of this index to stay above our 61.25. The probability cone says it could, right? 61.25 now. Oh, that's 61.40, 61. I'm so close to it. It's pretty close to where my mouse is. It just gives us a sliver more room. Not a huge amount, but just kind of a sliver. And I do like the open interest there a little bit better. All right. Let's also do this. Would like to show you, let's go back to the trade tab, and we're just going to say analyze the trade so we can bring it over to the risk profile. One of you mentioned that earlier. And I've got hide simulation, so I need to change that to say hide positions. And now we'll see our simulation that's sitting out there. And I'm going to kind of stretch this out a little bit. And our number we ended up with was 61.25. Now, somebody earlier said if you want to get super, super precise about it, maybe go to the risk profile. We're here in the risk profile. Up here, you can see this is our max gain area where we collect all the $50 per contract. Down here is our max loss area. What is it? We're risking a whole lot more, $450 to collect that 50. The reason somebody might be incentivized to do that is because the probability of the higher probability, right? When we were looking at it on the other page, yeah, about 80+%. Okay, and ours 61.25. And if I were to go ahead, let's see, this date, actually we're on the 6th today, so that'll change that purple line a little bit because that's as of this date, which usually we start it today. But we could come up here and we could go out to August 20, which is right here. And we could come to 61.25. And let's see here. I'm trying to get it exactly there. Because here's our 6100. And so my hand is kind of showing us the way. But it's not completely. Essentially, it's my hand is in the way. Oh, there we go. 61.25. There we go. It's going to be just kind of as we're getting this flat line exactly right in the corner. Should be our 61.25 as far as our strike price that's short. Boom. 61.25 and beyond is where we get that max theoretical gain if indeed the put stays above that area. Okay. Now we're going to put this on. We'll go ahead and put it on from here. We'll just do a copy, confirm and send. And the idea is we're going to be a little bit hands-off on this, and we're going to observe and see if we can capture a decent chunk of that. Now, during the week, if I'm watching and I see that this value of that spread, maybe say the market really takes off quickly, okay? And I can go buy it back for a nickel. Maybe, we'll go buy that trade back at a nickel, maybe 7 cents, okay? It's going to be just a very short time frame that we're looking at here. Now, I do hope that you are part of our Trader Talks channels. I hope you're one of our subscribers so you can see where our content is. It just makes it so much easier to find it, I should say. So here's our trading index options coming up next. Like I told you, it's going to be Brent Moores with managing an options portfolio. Now we'll have a little break in our time. He'll start right at the top of the hour. For those of you on the East Coast, that's going to be at noon. So maybe grab your snack or sandwich, bring it over to your desk. The other thing that's helpful here is you can get to the playlist. So you can go back to any of Ben's classes that he has taught or others on index options. And I'm just going to be searching for Ben's face here. And we might have to go down a little bit further. There's his flag patterns. Here's his futures. It's going to be coming up here next. It's got to be close. I am not seeing Ben's face. Technical analysis. Wonder if I may have skipped by it. It might have had somebody's face on there. I was just looking for Ben's face. In any case, this is where you can find our playlist so that you can go back and you can, if you're trying to hone in on a specific strategy, something of that nature, yeah, go to that. Today's class was a little bit more advanced than for our topic here. So if you're somebody that's newer, do what Cameron suggested right at the very beginning, which was to, let me get this here. Let's restore ourselves. Let me share this grid here with you. Thank you for the reminder. Share grid. It's going to create a little URL for us. I'm going to share that. I'm going to send it over here to the chat. Remember, anything that we share with you that's a URL is never guaranteed as to accuracy or timing. And let's go ahead and plop that into the chat. Okay, what you can do with that, bring over that URL. You can come up to your gear. You can say open shared item, plop the formula in there. You can do a copy paste if you want, and then hit preview and import. And then you'll have that grid there for you. All right. So I do hope you're following us. I did not see a survey out there today. So you're off the hook for that. But yeah, make sure you're following Cameron and I and all the coaches on X. That's where a great place to contact us is. If you have questions, use our X. Also, you can give us questions in the comments section of YouTube. All right. I've had people ask me questions that maybe weren't exactly aligned with the particular video they were looking at, but I'm happy to answer those kind of questions for you there as well. All right. Going to take a little break here, and then coming up, we will see Brent Moores with managing an options portfolio. For this specific trade, I am going to keep track of it, and if I do something with it, I will let you know in one of my other classes, like say short verticals tomorrow. If something major has happened, I'll let you know about it in that class. All right, everybody, have a great day in the markets. Thanks for spending some time here with us. We'll see you here in about 15 minutes.